Hi everyone, welcome back to our channel. Today we are diving into an exciting topic, the time value of money, or TVM. Have you ever wondered how much $1,000 invested in Nvidia 10 years ago would be worth today? Stick around to find out. First, let's talk about the time value of money. TVM. TVM is a financial concept that states money available now is worth more than the same amount in the future due to its potential earning capacity. This concept is the foundation of finance and investing. Now, let's pose the problem. Let's draw a line. Imagine you invest $1,000 in Nvidia at three different points. 1 year, 5 years, 10 years. Okay? Let's move this a little bit over here to organize it. So now, 1 year ago, Nvidia grew by 178%. That's right here, 178%. Okay? And 5 years, Nvidia compound at an impressive 97.8%. 97.8%. And for 10 years, Nvidia compound at a remarkable 74.5% annually. So how much would your $1,000 investment in Nvidia be worth today in each of these three scenarios? This is the first scenario, this is the second, and this is the third scenario. So now, let's break it down using the future value formula. The future value formula equals present value multiplied by, we open the bracket, 1 plus the interest rate raised to the n power, where let's draw a line here. We have at this point here, we have our n, we have the interest rate, we have the present value, we have the payment, and we have the future value here. FV is the future value of the investment. PV is the present value. This one here. I is the interest rate. And N is the number of years. So now, let's make the calculation for each of these scenarios. So, for 1 year scenario, let's write here scenario number 1. Okay, so let's draw our line here. This is for 1 year. Let's draw a line here. Okay, so now here we're gonna have n, the number of years. We're gonna have our interest rate. This is the present value, PV. We have a payment, and we have a future value here. Okay, so n is 1 because it's 1 year. I is our interest rate. for 1 year. It's 178%. And the present value is $1,000. Payment is 0. And we're gonna be calculating for the future value. Okay? So right here, we're gonna use our formula FV, the future value equals present value multiplied by 1 plus the interest rate raised to the n power. So in each variable over here, we're gonna replace each variable for its value, okay? So the future value equals PV, present value is $1,000. We open the bracket, 1 plus the interest rate. The interest rate is 178%, but we're not gonna write inside here 178%. We have to convert 178. We have to convert 178% equal to 178 divided by 100. That will give us 1.78. Okay, we're gonna write inside here 1.78 raised to 1. Okay, this will give us the future value equals to 1,000 multiplied by 1 plus 1.78 will give us 2.78. Okay, so our future value equals to $2,780. Okay, this is our result for the first scenario. So now, let's look at the second scenario. Okay, our second scenario is gonna be, we have scenario number 2. Okay, this is for 5 years. 5 years. Okay, so let's draw our line. Okay, we will have here N. We will have a interest rate, present value, payment, and future value. We'll have 5 years here. The interest rate for 5 years is 97.8%. Is 97.8%. The present value is $1,000. Payment is 0. Future value is what we are looking for. Okay, so we're gonna write our formula here. The future value equals present value multiplied by 1 plus the interest rate raised to the n power. So now we have N, we have I, we have PV, we have we're gonna calculate FV. So FV equal present value $1,000 multiplied by 1 plus the interest rate is 97.8%. So it's gonna be 0.978, okay? Raise to the 5 power, okay? Raise to the 5. Okay, so now our future value equals to 30,270 and 64 cents. Using a calculator, this is the value that I found for the future value. For our second scenario, the future value equals to 30,278 and 64 cents. So now let's calculate for the scenario number 3. Okay, scenario number 3 for 10 years. Okay, so let's draw our line here. Okay, we have our N, we have the interest rate, we have the present value, we have PMT, and we have the future value. Okay, N is 10 years. Interest rate is 74.5%. Is 74.5%. 74.5%. And present value is $1,000. PMT 0, and the future value, that's what we calculated. So future value equals present value multiplied by 1 plus the interest rate raised to the n power. So we're gonna replace each variable over here for its value. So the future value equals to $1,000 multiplied by 1 plus the interest rate. The interest rate is 74.5%. After conversion, we will have 0.745. Okay, raise to the 10 power. So the future value equals, using a financial calculators, I found that the future value equals to 261,490 and 87 cents. 87 cents. So our third scenario, our future value is 261,490 and 87 cents. So this calculation highlights the incredible power of compound interest and the time value of money. Whether it's Nvidia or any other stock, understanding TVM can help you make informed financial decisions. We have made a video about how to choose a stock. If you have enjoyed this video, don't forget to like, subscribe, and hit the bell icon for more financial tips and tutorials. Thank you for watching and happy investing.